Here's what to look for from the Canadian CPI print on Tuesday, March 18th. Now, at the last Bank of Canada interest rate decision, you can see that they cut interest rates from 3% to 2.75%. On the decision, Bank of Canada's Governor Macklem said that there was a case that they considered for keeping rates at 3%. They're seeing neutral at the current rate of 2.75%. So the reason they decided to cut was partly due to the uncertainty of tariffs, that was expected to weaken growth out of Canada. As they thought, well, let's do a sort of a preemptive cut. So that's what led them to that situation. However, the other aspect that confirmed that cut was that they saw inflation was quite close to 2%, right? So the median is at 2.7, the trim mean is at 2.7, that they're the Bank of Canada's preferred measure of inflation, but the core is at 2.1 and the headline is at 1.9. So okay, we're kind of close enough to get there. So what we want to look for now is something that pushes back against short-term interest rate markets, which are expecting a 25 basis point cut again in April. Now, Governor Macklem wasn't expecting that, but STIR markets are expecting that. So what we want to see is something that pushes back against that STIR market pricing. So the thing to look for, and this is why you need a calendar with minimum and maximum expectations. When it gets to the Canadian CPI print, you want to see what the maximum expectations are. And if the print comes in above those maximum expectations, then this short-term interest rate market pricing for a cut will get priced out. And the Bank of Canada will understandably be more concerned about inflation moving in the wrong direction, and you'd likely see a short burst of CAD strength. So that's what to look for the Bank of Canada interest rate, not for the Bank of Canada CPI print that's coming on March the 18th.